Good morning. It's Mortgage Pros 411. I'm Audrey Boissonou with my co-host Kevin Casey. We are.
Good morning.
Don't interrupt me when I'm about to say, welcome, Michael Ramin. It is so nice to see you today. Joining us from New York. You hate it when people try to, say it with a fake accent. Does that drive you nuts?
New York and coffee all the time.
How about when somebody from San Francisco says that San Francisco is like little New York? Does that ring true for you or no?
No.
I know. I heard that. I'm like, oh, he's cringing. Pretty sure. Oh my gosh. What?
I said very little.
Very little.
Very little.
That's
Yeah, they're
it.
not even going to let you put that in the same sentence, are they? All right. So we just want to start by saying thank you to everyone. Thank you, thank you, thank you. We have had the craziest year, right, Kevin? I mean,
Yes.
Huge changes and transitions. God bless you people. You have hung in there. You have figured out how to find us. You have logged in. It's been crazy and you've been amazing. So thank you. And our speakers, Kevin, like our speakers this year have been off the chart, haven't they?
Absolutely. Yep.
Yeah. Everyone from FHA, the CFPB to Michael Ramin from New York City. I mean, how lucky are we, right? And by the way, Michael, your hair is looking amazing today. I mean, amazing. Elvis has got nothing on you. You did it specially just for us, right?
I did just for. I don't want to disappoint.
That's right. Well, usually Kevin's the pretty one on this thing. He gets all sorts of comments about what he's wearing and how cute he looks and blah, blah, blah. Today, I'm sure they'll be for you. Anyway, no offense, Kevin, of course. None. Okay, wanted to take a moment and say happy Hanukkah, happy Festivus, and Merry Christmas, because we are off next week. So we are going to see you on January 3rd next. We'll have
You might as well include Happy New Year in that too.
Oh yeah, Happy New Year, for God's sake. All right, so with all that, a heartfelt thank you. Don't forget, we now have a website that works. Our videos are on it. They also connect to our YouTube channel, Mortgage Pros 411. So join us. And if you subscribe to that YouTube channel, once the video is posted, it notifies you. Apparently people like that little feature. All right, let's get this going, shall we? Michael, your specialty, you are in private money. So explain to me, because I love your story, how you started. Like, where did you start? What were you doing first? And how did that evolve into where you are today?
All right, awesome. So pleasure to meet everyone, and thank you for having me today, Audrey and Kevin. I'm excited for this. How I got in the industry in general, I worked in real estate my whole life. I graduated from college. I actually got a job at the MTA for New York City. So I was managing all the leased out real estate for the MTA. While doing that, one of my partners at work mentioned another job opportunity. Him and his brother started a title agency about 20 years ago. And he's like, you have all these connections in title. He's like, why don't you sell title insurance? And you have all these connections in real estate. And I said, you know what? I actually took the opportunity, looked into it, looked in what I could do. And I was like, off these commissions and connections, I could do pretty well in the title industry. And I actually went into my job and quit like a week later. So I went into a job with benefits, pension, and everything, and I rolled the dice on, I guess, my hair, and said this will hopefully help in a meeting or two. And I left that job. I came into the title industry and started working and building a pipeline. From there, two owners of the title agency were close friends and family at this point. Grew up together. They were launching with one of their brother-in-laws, which is now Sharestates. So Ray and Rodney DeVuti and Alan Scheinfecker are the three co-founders of Sharestates. Were launching it at that time. At that time, Sharestates was a equity crowdfunding platform, and then it converted over to debt. And when it converted over debt, we became a private lender, essentially, in a market that hadn't flourished or turned into what it is today.
Okay,
and,
hang on, let me stop you for 1 second, because I need
Sure.
you to briefly, in the simplest terms you can think of, explain what it means to go from equity to debt to somebody who's a loan officer.
So our investors that were investing into our products, if they were investing on the equity side, they would own partnership into the property itself. Coming in on the debt side, they would own a portion of the note of the mortgage, and they would get paid by that monthly. So depending on what they owed on it.
So it seems to me that there's probably a quicker turnaround on the loan side. If you're doing a loan, you're gonna get your money back faster versus if you do the equity share, it's a longer hold.
Absolutely. Our investors, came to us, a family offices and friends that we were working with originally, and they love the idea of having the liquidity, knowing it's a 1 to 2 year loan, and they were getting monthly payments. Typically on equity projects, you're waiting for the project to either finish, refinance, or sell to get your money back or a portion of your, capital back. So the debt became a lot more popular at that point. So we launched the
What year was
platform.
that? Yeah, what year? What
So
are
the
we talking?
company itself, Sharestates, about 10 years in now. So this was in the first 3 years. This is what was happening in the transitioning. Then we
Mhm.
started issuing mortgages and loans to Sharestates. I believe it was. I'll get you the exact year.
We don't
Forgot.
need the exact year. It's interesting for us from a mortgage perspective because the market has changed immensely over the
Oh, yeah.
last, well, always, let's just go with always. And so it gives us some context. And so, okay, so like 10 years ago, and so 3 years in, you're like 2015-ish. And then, yeah, all right. And then from there.
The market started taking off and people loved the product, but it still wasn't at a rate that was, I think, as palatable. Typically, private money, which originally everyone known of it as hard money,
Yes.
and it was essentially known as hard money because you're giving a loan on a hard asset, but it started getting a bad connotation because a lot of the original hard money lenders, private lenders, were, I wouldn't say predatory, but they were more loan to own type businesses. The business, and I think the process changed a lot over the years, and people that were investing into the notes wanted someone that was going to continuously take loans for them for a certain percentage and know that they would finish their project, and based on their credit and track record would keep coming back and buying, whether it was fix and flips or buildings, building a property up and refinancing and keeping it. So I think that was a big shift in how the market changed.
Yeah.
And from when we started, the rates were originally at 12, 13%, 12 to 14% 10 years ago. Then securitization started coming in, private equity firms, family offices. And then when the rates hit the single digits, I think you saw this market explode. People felt more comfortable seeing a 9 than a 10. And it even got down into the 6s at one point, like towards the tail end of COVID. And since, from before when COVID hit, so both of them, before and after.
Right. Well, it's interesting because we've talked about this a lot on this show where we need to expand our horizons. So I hadn't done a hard money loan in forever, and I'm working on like a couple right now. I've already closed one. This is a whole different thing, and I had to change my mindset around price because, like, to even mention it to a client that I've done many conventional loans to, and that what they want to do doesn't fit into conventional space anymore. I had to arrange my brain first before I could present it to them. And they're like, oh yeah, totally makes sense. Cost of doing business. Like, we have to really embrace the idea that the cost of doing business is what these loans are, and get over the rate itself. Does it work for your project? Does it work for your cash flow? Is that going to be palatable for your client to achieve what they want to achieve? Right. So it's, and when I'm talking to investors, they're all about exit strategy. This is in no way, like, they are not trying to own that property at all. They don't want to. So, I mean, that's my experience anyway. So that really resonates with what you said too.
Yeah, and to piggyback on what you just said about rates, in general, a lot of investors that are new to this, they've seen rates like in that 7 to 9 range for the last couple of years, and that's what they think this market is. I think it's a little short-sighted to look at it. Even if you're at 12%, if you get a fix and flip project done in 6 months, you're paying 6% to get that capital, get your project finished. That's a lot cheaper than bringing a partner in to buy it in cash and pay them 50% of your profits, or to buy it in cash and not be able to stretch out your capital. The reason for the debt was to be able to buy, instead of 1 property, maybe 5 properties at a time with the cash you have available. And I think private lending made that, grew this market, made it more accessible to people that were running their business through cash, friends and family, to saying, hey, you don't have a concentration of capital now. So instead of going to that mom and pop shop that's going to give you maybe $1 million a year, I'm going to open you up and get you a line of 10 million based on your experience. And now you can go buy, instead of 5 houses this year, you can go buy 20. And people have loved it.
So you in the private money space, did you say you're securitizing these things on the back end?
We aren't our loan buyers that buy from us. They've been doing the securitizations, but recently the pricing hasn't been the same it's been in the last couple of years, and now you're seeing higher rates and different investors coming back that were originally in these assets.
Okay. So what about the guys who close loans or the people who close loans at 6%? Are they crying every day now? Like what's going on with them?
I
Are
don't
they in
think so.
therapy? What's the deal?
I think in general, you got to take the good with the bad. You had like several years where you might have been making more and your spreads were higher. That doesn't mean you can't find deals now. In that time frame, there might have been less foreclosures, REO, short sales that they were finding opportunities in. Right now, those might be coming back stronger. And now they're going to be able to find more supply where there might be a bigger spread. So maybe paying that higher rate doesn't matter as much if you're making, X amount more money on it. So I think people that got into the industry when the rates were where they are, I think they're crying a little bit. I think borrowers that have been in this industry for 10, 15 years and were accustomed to that 12 to 14% rate, I don't think it affects them as much seeing the rate change. They're like, that's how I started and grew my business. And they're either buying in cash now because they've done really well over the years, or they're comfortable just paying that rate. And I think very important with an investor is finding someone that's confident in themselves, that they're not going to be like, I'm rate sensitive. Everyone's rate sensitive. You have to look at your numbers, and it's another line item in a spreadsheet, and it's going to be X amount different. Can you make money?
Right. No, I've been a big fan of private money for like especially buy first transactions versus sell first and then buy. If you buy first, the money you make on the transaction is so much greater that it's worth paying 12% for that service. And it's just when you do the math, it's like, this is a no-brainer. I'm going to make an extra. It's in San Francisco. You can make an extra $500,000 on the transaction as a buyer, because you're going to be selling at premium. You're going to be buying at a discount versus doing it the other way around where you're selling at a discount and buying at a premium. That's a $500,000 swing. That's when last time I did the math a few years ago. It's probably more today. And okay, so I paid $12,000 in interest. Who cares?
Yeah, if you made
I paid $500,000.
Yeah, 500,000, 100,000 doesn't matter. It's just a line item. It's a different cost. What I kept saying to everyone as rates were going up, I'm like, so you're going to stop your business now? So if you own the pizza shop and the cost of dough went up, would you close? You just raise your prices a little bit. People aren't going to stop eating pizza. They're not going to stop buying homes.
Right.
People are going to continue buying homes or whatever the business is. And I've seen a couple of questions and comments just pop up on the bottom as well. It's the same thing. Like it's a cost. It's another cost in your business.
Mm-hmm.
Yeah.
Same thing.
It's a big issue in our industry though. Jill says she's surprised by LOs who can't get over the rate versus the ROI. Clear is return on investment. Kevin always accuses me of throwing around acronyms without explaining what the hell they are. So anyway, the bottom line is I feel like we are the beginning of the block though. Like the buyer comes to us or the borrower comes to us and they have some idea in their head. And unless we have a way to help them understand that they need to get over the rate, it's about payment. If the numbers work, the numbers work, as Jill said. That's exactly right. So, okay, so let's talk. We have a question from Jan who's asking if you do owner occupied. So let's just briefly go into with Sharestates. Do you guys do just business use? What are you up to?
We just do consumer loans, so business use. We don't do anything owner occupied at the moment. I don't think we're going to get into that space. Our business was created around real estate investors. For LOs in general, for them, it's been amazing. Most borrowers come in, if you bring them in somewhere, and we're a relationship lender, you're able to do, most investors aren't coming in to do like one loan a year. They're doing anywhere from, 5 to, we have borrowers that do 5 a month.
Wow.
For an LO that's handling that client, you might not be making 3-4% you normally make on a conventional loan, but even if you're making that 1% and he's buying, anywhere from 10 to 20 million a year, it adds up to a big number. If you have 4 or 5 clients like that, it's obviously bigger. For the person that was asking a question about the owner occupied, like private lending products, I don't do them. I have a couple of people I know. So if you email me, I'll make you referrals. And if it works out, that's all you guys. Have fun.
Great. Yeah. There are places that are doing owner occupied. So it's
just a lot more hurdles to handle.
Absolutely. And depending on state, the laws are definitely different with
very different. Yeah, exactly. How many states are you approved in, Michael?
We're in 40 plus states. There's a couple that they require like commercial lending licenses, and the volume there isn't enough to warrant getting the licenses. Some of them are brick and mortar, but we're in the majority of the states that are fairly active.
Mhm.
We don't do Alaska, North and South Dakota, Utah, Oregon. I know it's Nevada and Vermont.
That's interesting. Interesting. All right. So moving right along. So as we look at, okay, so the industry has changed always. It's always changing. Always,
Oh.
always, always. That's like the only constant is that it never stays the same, right? So as far as what you're seeing on your end as things evolved, underwriting guidelines change, pricing changes, hits change, your appetite for certain loans comes and goes. Tell us a little bit about that.
Yeah, absolutely. So it's probably different on both sides. So you'll see on the bridge side. So let's say you're talking about regular fix and flip loans. You know, there's a point where the market, and some lenders might still do it today, they're giving anywhere from 90 to 100% of the purchase. You'll see a lot of that's come down, whether it's 10 or 15 or 20% on leverage upfront.
Uh-huh.
So you've seen that change. You've seen loan to cost. That was at that 90% mark. Some people were doing 100% loan to cost. You see that more in the 80s now. Some people still do up to 90. You don't see the 100 as much anymore out there. You might find a couple of people that are, if you have an extremely high track record, like 30 properties a year, 30 paid off a year, they might still give you those terms. But with values coming down, I think there's a little bit of fear on that going based on the ARVs. There was a point where ARV after repair value was going up to 80%. You've seen that come back down to like 75, 70, and some lenders down to 65%. And a lot of this is to obviously mitigate risk, but also feel comfortable knowing if values drop more. And a lot of that changes with obviously mortgage rates. So conventional mortgage rates, as they went up, you saw a lot of people that were in contract lose their contracts. Their DTI, the loan just didn't work anymore if they weren't locked in. So you've seen that change a lot on regular fix and flip. Credit also became a factor. It wasn't as popular as a factor on fix and flip loans. Typically, you were taking borrowers in the 500s, low 600s as their experience weighed heavily. They're looking at credit a lot higher now because if the borrower can't sell the home, can they refinance into a conventional loan or a non-QM DSCR loan? Same thing you're seeing on the DSCR side. The rates were, high threes, mid fours, a year ago from today.
Right.
You see those same rates right now. You'll see, anywhere from high sixes at some places all the way to 8. Factors that
That's
would
still great, actually.
I don't think it's bad. If you could hit your DSCR numbers, it's another number on the spreadsheet. So if you're paying 8% and your DSCR is still 1.5, so it's not like the 2.2 you're getting, you're still making the money you projected on making 1.25%, probably
Right.
going into a project. Borrowers are still hitting it, especially states with higher rents, lower taxes, works better. But you see borrowers with lower credit are getting bigger rate hits, and you're also seeing bigger rate hits for higher leverage, cash out, stuff like that. So 10 months ago, 75% cash out, everyone was getting that because the rate was like 4.5%. You see a lot of borrowers now that same hit, like it's more comfortably at like a 65% leverage. The product is still out there to get 75% cash out, also to get 80% on a purchase on a non-QM DSCR loan, but the rate just changes by a big number.
Right.
Yeah.
Before you might have been affected by like 25 basis points on a rate. Now you see like a 1.5% change in the rate.
Wow.
I did
Rates
an
are key.
interview
Rates
with
are
a couple
key.
private money lenders, and they're telling me how their investors, the number one thing they're looking for is strong cash flow and security of their investment. Is that, would you say that's the
So
Exit strategy. I'm hearing exit strategy.
Yeah.
Want to know that borrower can get out.
Yeah, credit, cash flow. Right now, credit and liquidity are the most popular, and obviously a track record. They're going to look at experience. Investors that buy paper from us, they're very curious on how many payoffs has the borrower had for you, like with you. So, and as we're talking right now, like so rates actually just went up on one of our non-QM guys. So that just popped as an email. That's always fun.
So who triggered that? Your investor that invests with you, like he's asking for more money right now, or more?
No, there's just a rate change in the middle.
Oh, that was your internal rate change. Okay, so tell me how that works. So we've seen mortgage rates come down a point plus in the last month. Have your rates followed suit? Do they at all mimic the conventional market? How does it work with pricing private money?
So they mimic a little bit. So on like the fixed rate bridge side, typically it's like a set rate on that stuff. It doesn't change much. It obviously changed from earlier this year till now. For the DSCR loans, a lot of it's based on like the 5-year swap. So you'll see a change on that. So if that's gone up or down. A lot of people price a lot of things off like the 10-year treasury, really doesn't do much with that. So it's like the 2 and 5-year swaps. Also, it has to do with how much liquidity is in the bond market.
Interesting. Okay, so the bond market does impact you to some extent.
Well, yeah, because the option is you're competing with the bond market because the person could buy treasuries or.
Well, that was my question though, to begin with. So
Yeah.
I read this article that the CFPB has an issue with some of the DSCR loans, supposedly. And again, I didn't read this from the CFPB's website themselves, but that they feel that, or they have found that DSCR lenders are not tracking income on bank statement loans, or not DSCRs, so bank statement loans, to make sure that the income that's being used is actually from a business. They seem to be doubling down on that. Have you heard anything to that about that?
We're not dealing with like those types of loans, so I haven't heard about it. On our end, we are verifying, obviously, like the verification mortgage. We're verifying their bank statement, making sure the funds are there, verifying that they're real leases and actually occupied through appraisals. But on that end, we don't deal like with business income on any of our like STIPs on like.
Oh, okay. I thought you did bank statement loans. No,
we do only DSCR loans, so it's
I see. Okay,
that's
all right. That
bank
makes
statement
sense.
will probably be a lot more with what they were asking for before on the chat. But we haven't dealt with that on the consumer side.
Okay, got it. All right, well, that makes sense then. I'll ask somebody else that question. I just thought it was interesting because I'm like, okay, we've been doing these bank statement loans, right? It's non-QM lending. And so it's outside of the box. And as far as verifying every single deposit that goes into a business bank account, like how on earth is that even feasible? So yeah, that I have a feeling we're going to hear more about that for sure.
So I have a question is how are you saying you've got some loan officers that are like have these clients, there's one after another transaction. How are these loan officers finding those clients? Because that's what I want to know personally. It's like, how do I find these guys?
It's in multiple ways. I think if it's a conventional loan officer, so you're doing it 3 years and one of your realtors or clients keep referring to your business, you'll get curious, like, all right, this realtor referred 4 loans this month, where is she getting them from? So typically she might have been doing open houses for one of her investor clients that she sources homes for. Typically you'll see a lot of mortgage guys work with realtors that have either investor clients out there. A lot of times that investor could buy more property if he had the accessibility to capital. So sometimes the realtor will make an introduction to the LO, and now he's able to shop it out and get better cost of financing for that borrower. So you see a lot of them get like that. A lot of it's just networking, going to networking events.
Yeah.
And then realtors in general, get first look on a lot of properties. So as much as they sell to end home users, a lot of them are flippers themselves. And the business has grown over the years. You see these shows on TV, you see influencers on Instagram that are doing it. A lot of loan officers that I work with, I've had a couple that said they've met their clients on TikTok or Instagram, just by posting content saying, hey, I do these types of loans. And the guy's like, well, I do 4 flips a year. I was using XYZ lender, or I was borrowing money from like uncle. I rather work with you guys and not involve my family or anything else. What can you get me? I've seen people get borrowers in the craziest ways. I've gotten some borrowers in the craziest ways. Like I was at a restaurant and I took a call with my wife at the table, and close restaurant, so the tables were side by side. The guy heard me speaking and he's like, oh, I've heard of your company. And he's like, I've never thought to reach out. And I ended up getting a loan from that guy. And he does like 20 flips a year. That's
Wow.
randomly how I met somebody.
Wow. So I guess you get to write that dinner off. Is that right?
I don't know.
Oh my God, that's crazy. But again, it involves getting out into the world and meeting people and talking to people about what's available. And I think there's still a lot of realtors and a lot of referral sources who have no idea that these loans and opportunities exist. And that's what we're for. You
I think
get out of your house and you go and tell them about it, right?
I think also when the rates went up and conventional loan officers weren't able to do as many refinances, the cash outs were gone. Something when someone really needed cash out, I think that business went down a lot. And as a loan officer, you're used to doing a certain amount of loans a month. Most loan officers are very aggressive. They work very hard for their clients, they'll fight for them anyway, and they also will fight for other programs. And we've gotten a lot of guys that have come in, and I was doing 10 refis a month, and that dried up. I'm working with some of my investors on the regular guys that I've worked with for years. When I reached out, I found out they own rental homes and they can actually take loans on them now. So they bring us the non-QM business. You have guys that use different ways, but loan officers have definitely used the private programs to grow their pipelines and do more. And I think the brokerage industry in general grew a lot within the last couple of years, with companies dealing with like UWM or Rocket or any of these other guys out there. Absolute. I think the broker industry just grew a lot from people dealing with conventional, mortgage or direct banks.
It is, it is a function of purchases are the name of the game for most, should be. Refinances are dessert. That is not your protein and vegetable serving. That is dessert. And everyone got drunk off of so much dessert, right? And so we need to refocus and go back to basics, which is purchases. But then this investor business is huge, and it requires us to think outside the box. So somebody's asking for your email address because they have a deal that they think they might want to send you, and it's michael@sharestates.com, right?
Yes.
Very, very, very complicated. And we'll make sure that we'll put your email address we'll embed it into the YouTube recording too, so that it's there when they click on it on YouTube. So if somebody misses it, it's not the end of the world. But again, this is about there we go. So Mike, okay, so you just posted it, Michael, but it just came to the hosts and panelists, not everyone. So maybe there's a drop down, I think, that you can use. All right. So with that being said, as we look into 2023, because 2022, it's winding down, and I hear a lot of loan officers who are just basically taking the rest of the year off. And we've been pushing, you got to keep your momentum going. You've got to have a plan for 2023. We've been telling them since October, get your plan in place now and start working it now. There's no reason to wait, right? So as we go into 2023, what are you expecting? And we don't expect a crystal ball. And at this point, we kind of think all projections are bupkis, but as you're looking forward, we have to have some forward vision. What does that look like for you?
I think 2023 is going to be big. I mean, we've seen inflation come down the last couple of months. I think in the conventional world, you guys have discussed rates coming down with 1 to 1.5%. I think they'll stabilize a little bit more, drop a little bit, but there's been a shortage of housing for years. I think people are still looking for homes. I think builders and lenders for builders are still pretty bullish on it and looking to build, renovate. I went to a conference several months back, like build to rent, and there's guys still building 1,000 home communities and still getting it up. You'd see it with the ADUs became very popular. So there wasn't enough homes, so people are building accessory dwelling units on their property. Towns are making it more accessible. It's hard to build a new town. If the town's over there, you find somewhere to put more units. So I haven't seen that demand go down. I have investors that we work with and we source properties for as well, because they don't have the time, or deals come through that bars don't qualify for, and they're still looking. So as long as a deal there, something's distressed, I think they're going to build it. I think you'll see rates stabilize in the beginning of the year. I think by the end of like Q1, I think you're going to see business pick up a lot. I think you'll see rates start dropping a little bit middle of the year. Towards the end of the year, I think you'll see a bigger drop. I don't think you're going to see those like 3 or high 2% rates, but I think our industry will do really well, like with conventional rates in the mid 4s to low 5s. I think a lot of people have heard those comments from like older people and family members that like, oh, when I was 30 years ago, I paid 18% of my mortgage. You guys are crying about this. I said, yeah, your house was $100,000 and your property tax was like $20. That doesn't work now.
Their income was like significantly lower too, Michael.
Lower income also.
Don't go dissing the old people. Come on.
I'm not dissing the old people. I think our market has changed from the home values, but taxes in general. Taxes, I think, are what makes it a lot tougher.
We've been talking about that because in California, we have Prop 13, which limits the amount that your property taxes can go up. But I've heard whispers of it thus far. I keep waiting for it to be a huge issue because while property taxes here can only go up a certain amount, if somebody's place appreciated 30% in the last 2 years, they're going to have an ugly surprise when they get their property tax bill. So that's going to be really interesting and hopefully not terrifying to watch unfold. Yeah.
Yeah, I think it's part. I think whether it's a state or a city realizes that there's a deficit or a shortfall, it's going to hit again. Costs have gone up. People always complain like my roads are not good. I don't have lighting.
Yep.
You know, there's either issues with crime. We need more policing. Whatever it is, you're going to pay for it. It's not free. So
Well, I'm interested too to see all some of the states who have had this big influx of people moving there, and it drove the prices way up. But also, guess what? All your costs are going to go up as a state. So where it might have been affordable before, I'm just fascinated to see how this all goes, right? Like if you're having to provide more services for a ton more people, it's going to impact everything. And all of a sudden, maybe the taxes won't be as I don't know. We'll see. It's all the jury is out, right?
But to go back to your original question is, I think 2023 will be a big year in real estate. Towards the end of the year, I think is where you're going to see like another 4 or 5 year run. And I think one of the larger mentors and real estate attorneys in our industry, he mentions the same and he feels it. People are still very active. They're still looking for deals. I think people have become more active as people have stepped to the sidelines.
This completely jives with what we've been hearing from a lot of the industry experts. And so it's nice to hear that things are going to look up. I thought it was really interesting. Thanks to Barry Habib on MBS Highway. He referenced this article from 2014 out of American Banker magazine. The title was, "Is it time to quit? Is it time to quit?" So it was literally like the list of reasons that people were considering quitting in 2014 is the same as it is today. Yet if they'd quit, they would have missed out on all those gains in the last couple of years, right?
Yep.
So is it time to quit? No, it is not. Never. And actually, we thought this was interesting too, because we've been tracking the NMLS renewals to see how many loan officers really are staying in the game, how many are quitting. And I just had this conversation with a provider yesterday, and it looks like we're down. We may end up
23%.
What?
Down 23%.
No, he thinks it'll end up being 10 to 15.
Yeah,
It's
that
not
could
that.
be. I was getting a lot of calls just last week from people saying, "Hey, how do I?" I'm like,
I know.
waiting
I
till just
mean, as
now.
much as we've been beating the crap out of everyone for months, telling them to get it done early, no, still. And by the way, what are you doing with your days? You're not closing 27,000 loans a month, so get your NMLS done early. But no, they're still scrambling at the last minute. So it just blows my mind. But it's how we roll, right?
Yeah.
Hello, like a. But you don't want to let your license go. That's insane. It's too hard to get it back.
Well, you know what? I think what has to happen is they have to do it once and realize, oh, this is a disaster.
What I think is changing is I think that some people who got licensed in a ton of different states, they're letting some of those go.
Yes,
that is happening.
I'm hearing that a lot. A lot
Yeah.
of licenses are getting
I see a
lapsed.
lot less realtors selling a home in the last year. It's
Uh-huh.
very easy. Every house had 20 offers. They're like, oh, why don't I go sell homes? I think you'll see a lot less realtors, and the people that have been in the industry longer and fight it out, I think you'll see that grow. Same with the original mortgage guys that from when I got into this 10 years ago, those are the guys that still have the crazy volume today, regardless of, and they've done with dealt with market shifts. I think 2008, 2009, when everyone was like scared or there was no business left, they took a month off, they came back and they made it work. At the end of the day, just looking at it, it's going to be there. And going like goals for like 2022 to 23, I think you just double down on your goals from 22 and you push harder. There's going to be more opportunity with less people. You have less loan officers, you have less realtors, you have less investors. For the people that stay in, the harder you push, you're gonna have a very good year.
Yeah.
Right. Well, and we were talking about how the volume in 2022 is over $2 trillion. There were loans closing. That's origination volume. That's business was happening as we're all lamenting. And meanwhile, there's all this pent up demand and the MLS searches are off the hook. And so people are waiting because they were afraid, right? So
Yep.
we talk about our job is you get out there and you set the record straight, because a lot of those headlines are complete garbage.
It's interesting because, and when you talk to other loan officers, the ones that are doing private money, especially the ones that focus on it, they're killing it right now.
Yeah, in non-QM.
Yeah.
I mean, the tough deals, if you're not afraid to I'm hearing crazy stories from a few lenders who are literally putting the most insane rates on their LEs, like 15.99, 16.99, not knowing exactly what they're going to need to have to deliver to the market. And depending on the situation, the buyers are just like, when can I close? And so I'm not suggesting that 17% is for everyone by any stretch. I'm just saying that if you're willing to double down and work on those tough deals and be firm with your borrowers and not let them make you feel bad about the market and the rates, then you're going to close loans. That's it.
Yep.
Yeah. It's
The rate. I think he just meant like they make you feel bad, like, oh, how are you charging? I'm not charging you this. That's what the rate is. That's the product that's there.
well,
Yeah.
I think that sometimes, I mean, buyers do, or borrowers do oh, well, so-and-so said, yeah, oh yeah, can they close it? Is that
Yeah.
lender going to be there when you go to close? How's your appraisal? Is that going to come in? Because we're hearing a lot of crap about crap appraisals. I mean that with love in my heart, of course. And so it's an issue, like who you're using as a lender is an issue. And it's not just the rate, it's the process, the
I
time.
had a
the
situation
appraisal.
last week. I had went to a Christmas party, and there was a realtor at the party. Texted me on beforehand, goes, "Hey, I just was talking to the owner of a restaurant across the street from the party, and he has a private money loan at 10.5 and 2 points. And do you think you could do better than that?" And I'm like, "Well, that sounds a little high, but I'd be happy to talk to the person." So we go after the party. We stop in at this restaurant. I meet with the owner, and he was borrowing I think like $350,000 on a second, but it was a second loan. I'm like, well, 10.5 on a second is not unreasonable. I go, well, let me see your note. And it turned out it was from the same lender I would have gone to for the money. And I'm like, well, let me just tell you this right now. This is a good guy. You're borrowing. This guy's legit. He's not trying to scam you. And honestly, if you'd come to me first, I'd have gone to him, and I would have charged you a point on top of what he's charging you. So you're saving money. I go, but tell me what your concerns are. I was able to actually call the private money lender and work out a little bit better term for them, not on the rates and stuff, but how it was being repaid. And so the client, was all I was doing is making a phone call, so I didn't charge anything. But
It's mighty big of you, buddy.
I wish I could have on that one. But hey, he was
Only a phone call is 2 points.
yeah.
Exactly. Jill is saying that
This guy's like that, though. You know that.
Trust me, I know.
Actually, that's actually a thing. So this guy one time, he introduced me to a deal, and he goes, well, I want a point on the deal. I'm like, wait a minute, I'm doing all the work, and I'm pulling all my expertise. And just because you made an introduction, you want a point? That doesn't make any sense.
RESPA. The
Yeah.
word is RESPA. That's
Yeah,
all.
it was commercial
RESPA.
deal, so there's no RESPA on
Oh,
commercial.
brother. Okay, then don't be it. Oh God. Oh God. A word almost flew out of my mouth. I stopped it just in the nick of time. Anyway, just be a decent human. Let's just go with that, shall we?
Yeah.
So we do have a few more reports this week, just for the record. We have existing home sales on Wednesday. That can be a market mover. And we have PCE Friday, which is another inflation indicator. So make sure you stay alert. We're having a weird day on the market. We know how this goes. The trajectory is never all, straight one way or another. So we are going to have these bumps in the road, and we've had huge gains recently, but just be on a lookout. And especially as we are going through this next week and a half or so, 2 weeks of holidays, the volume is usually lighter. And so the volatility is more extreme. So you will have less traders. So anything that's happening is going to be exacerbated. So just be on the lookout. We always have more to lose than to gain, it seems. So just be careful, guys, as we get through this next week and a half. The market closes early Friday, I think, and it's all the way closed on Monday. Yeah, you're shaking your heads. Yes. So anyway, so just be on the lookout and make sure you're locking carefully and watching what you're doing.
Yeah. Hey, Michael, I got a question on a lot of the fix and flips. So what mistakes are fix and flippers doing that's getting them in trouble, if any that jump out of you?
Yeah, absolutely. I had one the other day, fix and flipper with us, Florida deal he bought about a year ago. He got offers on the home that is not what he was expecting. And he's like, oh, I want to go into a rental one. I could get higher for this home. And I said, if the prices come down and you've had it on the market in one of the hottest markets and you're not getting the offers you're thinking about, why would you extend the risk on this?
Right.
Like you're still making, like I knew his numbers because I took the loan in for him. I've known him for years. And I was like, why would you take the risk? Like you're still making you're trying to make 50,000, like more on it. Just sell the
Right.
home. You're still making 200 grand. Like it's good money after bad. Like,
Uh-huh. Why risk
why
the
risk it?
200
So,
over 50?
yeah, I think one of the biggest problems like fix and flippers will make with that, and this is one of the biggest problems in general with fix and flippers is don't get married to a project. If you get
Mm,
stuck at a project or it's bad and it becomes a money pit, sometimes it's better to lose 20,000 day one than to lose 100,000, a year later. So that's one of the biggest advice I always give to flippers is like don't get married to something. It could have been your dream project. You could put your heart and soul into anything, but if you look at it like that, as if like I have to make a certain amount of money, or this has to sell for a certain amount, or I have to put these finishes in it to make it, like do what the market is asking you in that area. If the market is not asking for granite countertops and marble floors, don't put that in your house because you're spending more money than you need to.
right.
It's just crazy. So I always tell people to speak to realtors, look at the comps in your area, look at what recent flippers did that sold for the highest price. What did they do that attracted it? Maybe it was amenities within the home and not the actual cost. Like,
Yep.
did they need security cameras? Little things that cost maybe less than finishes will make something a lot more palatable, attractive for people to buy.
Yeah.
It's always cool to make sure you have like a room. A lot of people, if you're building a home in a certain area where people have their older kids or college kids living with them, see if there's like a apartment above a garage, or you can have like a basement with like an additional like egress, so someone could come and go as they please. Works well in certain communities where people have their parents living with them. So I definitely tell people to look into the community a lot. For flippers in general, very important. If anyone's listening today that's a flipper themselves, you're going to a new community, go to like the housing department. Make sure that you can get your plans approved there. You're not going to run into problems. The guy in the housing department's not some guy that doesn't want to see his town change or progress for the better. And he's going to keep your plans. Like right now, I guess San Francisco is a great example. Multifamily homes, over a year wait for plan approval on ground up. Single family homes, almost close to 2 years. If you're a
Yeah.
flipper, like don't look at building ground up there. You're never going to finish your project.
Right.
You look into different areas. So I think it's very important for flippers in general to look at this information. Make sure that there's not big law changes. In Long Island, in Suffolk County, there was a law where your waste pipe had to be a certain amount if the home was after a certain date. So even if you're doing a regular fix and flip, now you're sitting there trenching and changing the pipes going in and out of the home. Those are costs that they're not small. That's going to eat into your profits. It might create a loss. So I think it's very important to look into that. Make sure that if you're going to do light work in a home or change a window, you don't have to get plans approved somewhere or get drawings. That can also hold up a project or cut into profits. And if you have time you have time to get an engineer in there, very important. Make sure that there's not a problem with the foundation. You're not going to run into mold or something else that can be an exorbitant cost. Another advice I've been giving flippers is sometimes more work is better these days. We realized during COVID that people wanted more space in their home. After you got locked into an apartment or a house and you're all in one room, you're like, this sucks. I got to see my, whoever sibling parent for this many hours. They went crazy. A lot of the flippers I worked with, they started doing extensions, dormers. So they couldn't find a good spread on a home by just fixing the interior. They added on a floor, they added on this extra room, they added on something else. And I think a lot of that has been popular in growing their businesses.
Know
Yeah.
your market and make sure you have a plan so you can get in and get out.
Yeah, exit strategy.
Time. Like every minute costs you money. So make sure
Absolutely.
you're
No,
get in and get out.
the advice about the what to use to put counters and stuff like that. It's like, yeah, keep in mind who the buyer is. Is the buyer high end or low end? If it's low end, keep it down. They're about the cost, not how fancy it looks.
Are we allowed to say low end anymore? Is that on the acceptable list of terms?
Yeah, I think that one's still there.
It is? Okay, good news. That's really good news. Okay, just want to put a quick plug in for Coach Katie, who we've had on our show a number of times. She has a coaching program right now for $98 a month for and maybe that's what it takes to get people on track. So if that's what it takes, that's really, that's the most affordable thing I've ever heard of. So her information is on our website, should you be interested. Meanwhile, freight costs are going down. I thought that was good news. Gas prices are going down. I mean, in theory, the inflation numbers should continue to moderate, if these things that have been big drivers in those numbers are decreasing, which it seems
Yeah,
to
no,
be.
huge drops in lumber, gas, things are starting to drop. So I think you're going to start seeing more contractors doing more stuff. Although the cost of labor is brutal, and are you seeing that on the fix and flippers and the cost of labor for these guys?
I've seen that. I've heard. So the biggest complaint I heard in the last year, I guess, was so many home sales and everything going on that people couldn't even find labor. So right now, I think they've been able to find more workers and more labor. So they're just happy someone's there at this point. I think they've been happy with the cost of materials, gas, etc., coming down, getting delivery, shipment, getting your stuff. I think it's been great.
Good.
So are there certain states that you're seeing more of the fix and flips in? Where's your strongest activity? I mean,
So, we're
New York,
based in the
maybe
Northeast,
there,
so like New York, New Jersey are our biggest states. I think I just saw a question on there. Also, I'll get into that in 1 second. But you're seeing in other states like Midwest, like you saw during for like rental loans, you saw places like Ohio took off. St. Louis, like so in Ohio, it's either like Columbus or Dayton or other places like that. St. Louis, Missouri was popular. Memphis was very hot for a minute, still hot. I think people got priced out of Nashville. Driving 40 minutes in another state to your job or an hour is kind of similar to, that might be like maybe a 10, 20 mile drive. Similar concept to that same drive of like 20 miles in New York is an hour drive. 60 miles in Memphis is an hour drive. So
Yeah.
You'll see that difference where people will live in Memphis and drive to Nashville for work and have a lower cost of living. So you saw areas like that super popular. I have an investor I'm working with. He's in Arkansas today looking at deals. Seeing a lot of people go to different places in Texas. And I think a lot of people have heard the name, Austin. I've been going to Austin. But Houston has been hot. Dallas, if you go there, there's cranes everywhere. You'll see what other states. The Carolinas have been hot for years, ever since I think Boeing went into South Carolina. Both Carolinas have been very hot. You've seen North Carolina recently, similar to California. They added the ADU law, so you can build accessory dwelling units, and I think that's been popular for people to, build more housing. At the build to rent, we saw Colorado. So almost anywhere in the state, but Denver, outside Boulder, people are building homes. And then Arizona, all over. So that's been pretty popular. I see a couple of questions here. I don't know if you guys want me to answer them or not.
Yeah, for sure. Let's go.
I have a lot of investor contacts in New Jersey and Pennsylvania. Are there licensing hurdles I need to overcome for those two states for DSCR and or commercial loans? I am licensed in California only. So for those two states, you're not going to need a license like you need in California. I think the states that require the licenses are California and Arizona. We're licensed in both of those states, but the brokers are required to have licenses in those states, so you should be fine. And those is Florida still the hottest market due to the move-ins, etc. So in general, Florida seemed very hot for a bit. It's still popular, but it's not the hottest state. A lot of people that move there move back. So sometimes when you hit a summer there, you're like, I'm not doing this.
Or a hurricane.
Or hurricane.
Two in a row.
You hit a summer. You hit a couple of Florida headlines, and you're like, "What? This really happens here? This wasn't a joke on the news."
Yes.
So I think
wait, that's a bug. I thought that was a small animal. The bug.
We talked about this before. You could put in any date, and this day in the news, a Florida man or something crazy comes up. Florida is still very popular, but I think prices have dropped there as well. I have a lot of friends that moved there and stayed, and they've seen the adjustments. It also depends where. Florida is a big state. You got to think Florida.
Yeah, huge.
You think New York would have a higher population. Florida has a higher population than New York. And a lot of people, when we look at it, it might be a smaller state. It has more density. New York has most of our population within Long Island and New York City.
No, Michael, Michael, it's because all the New Yorkers moved to Florida
So
eventually.
they had a higher population.
Eventually, like, come on, isn't it hereditary? It's in your DNA at this point. You have to move to Florida if you're from New York.
You have to, if it was me, I would move to San Diego at some point,
Oh,
but
God. Okay, we won't even go there. Yeah, a lot of people love San Diego. It's not my weather.
So Michael, I got a quick question. You talked about a couple states that had ADUs like California. What other states are now doing ADUs like California
I
auxiliary?
know North Carolina is one of them because we had questions on that and appraisals. Yeah, so these funny conversations. So yeah, you definitely, I know those two states. I can get the actual list of states from one of our compliance attorneys, but there are other states that are allowing it.
Okay. I was curious
and-
how much it was spreading from here, because I know we were one of the first to do it.
I think it was 6 states recently that
Okay.
popped
Wow.
up with it. I have the list somewhere. I don't remember them as much.
So those in other states, you know, the ADUs are auxiliary dwelling units in California. Now, any single family home, you can add another unit onto it, at least theoretically. Sometimes, as you said, in San Francisco, the building code process can be quite cumbersome, but in theory, you can add it. It's really popular in units. So if you have like a 6-unit building with a large backyard or even a semi-large backyard, you can add almost unlimited units onto that. So you can literally put another building behind the building. And so
Your neighbors will hate you forever, but whatever. And just a quick Grant, I know you're in, I know San Diego's lovely. I get it. And you and Michael will live there happily ever after eventually. But I just like a change of seasons. I mean, I just, like I want to be cold sometimes and hot sometimes and something in the middle sometimes. So anyway, so I didn't mean to dump on San Diego. Plus, I think I'm a little bitter. One of my kids moved there for 3 years. I missed him desperately. I was so happy when he moved back. So anyway, yeah, we have the overreaching consensus is we have so many opportunities going forward, and we just have to embrace them. And again, there will be less people in the industry next year. And it was also really interesting, that stat, Kevin, that we saw a few weeks ago, where there's like 100,000 loan officers who do less than 3 loans a year.
yeah, in the hottest market.
What?
In the hottest market.
In the hottest, yes, in
Yeah.
the hottest market. So again, we just have to go back to being salespeople.
Yep.
You help people, you have to get out of your house and go do something different.
I have a question. Of the licenses that didn't renew, does it tell you the age of the person? So you know if it's whether they went to a new industry or they retired?
I don't know that it does. I don't think so, but yeah, that's a great question. I don't know. Yeah.
Very curious. I mean, I could see obviously people dropping out of it with, job cuts and without the refis there, but I still think it's a good license to hold on to.
We have a good friend, Harry, who's in his 70s, and he finally packed it in. He's like, and so he might even be watching right now, but he's in his 70s. He got to the point where DRE no longer required him to even do the continuing ed part to get his DRE license. And but that's enough for him. He's having this fun, but so some people are retiring, that's true. And there are always the people that are going to get in to make a quick buck. But again, the numbers we had seen didn't show, like, there was not a monster influx of LOs in the last few years. I mean, it wasn't what we thought it was.
Definitely the LOs coming in are definitely dropped off, but there has been some drop off even in people renewing. So
Yeah.
And I had a funny story. Someone called me the other day about renewing their California DRE license. I'm like, wait a minute, I think you qualify for the senior.
God. Right. Somebody said the average MLO age is 55 and up, and which we think is true, but we're meeting some new people. Like, I was at a party in down south last Thursday, and I met a 28-year-old who's been in the business for a year. And he is, like, there are new people. We have to find them and help nurture them, though. We want them to be successful. And this market is a little, terrifying for someone who is seeing nothing but refis falling out of the sky. So it's our job, take a moment and help them. Yeah.
Absolutely. I think it's very important. And it was great. We have, forums like this, but I think educating and motivating people to do the business is very important. And obviously to do it the right way. I always push for our industry in general. I think it's very important for people to keep everything like very clean. I think our industry still like it's in infancy. You've seen this expand a lot in the last 10 years, and we probably hit two of the craziest rough patches you could have seen within an industry. You got an industry that was blowing up, growing, whether it was securitizations, different funds being built, everything. And right before COVID, probably the biggest numbers going out monthly. And then it just stopped like March 2020 at this point. Literally, you had a full pipeline and everyone just stopped doing closings for a bit. And it did turn on shortly after that. And then it turned on, and it turned on hot and fast. And there was a lot of capital in the space. And then you see like February of this year, everyone's like, I think the rates changed a little bit. And everyone's like, it's not going to change. And then it just started changing fast.
Yeah, crazy.
You had a rate one morning, it was 4.5. Then next day, if you didn't lock it in, it was 4.75. And if you didn't lock it in then, by Monday, you could have hit like 5.25.
Yeah. The volatility was what was so nauseating. It's like you can handle changes, but the volatility, the up, the down,
Volatility was
out of nowhere. It was just like, ugh. But again, I remember 93, 94. It was like somebody flipped a light switch. Michael, I don't even know if you're alive then, but the rates just went up overnight. It'd been this huge refi market, and then all of a sudden, poof, nothing. So it's those lessons, they just repeat themselves over and over. We just forget them. That's the problem. And the people who weren't there don't believe us until it happens to them. But once this is over, they'll forget. We'll all forget this too. Like we get amnesia, for God's sake. We have to remember these lessons and remember that we're salespeople, and then we have to stay the course and do all those activities like, stay in contact with your clients, stay in contact with your referral sources, et cetera, et cetera. So for a takeaway, Michael, as we reach the top of the hour, what do you have? What would you like to share with everyone as we wind this up?
I would like to share that I think everyone should be excited for 2023. What you guys mentioned, renewing your licenses and business picking up. You might see it's still quiet. I think it's a good time to build your network and reach out to people in January. I do think home sales will pick up. New construction, people are still building with the cost of everything coming down. I like how Jill is excited for 2023. I don't think, like, if you sit there with a negative attitude and anything like that, people are not going to want to work with you. So be positive. If you go up to someone and they're telling you buying a house, don't be like, oh, it's not a good time to buy. It's a great time to buy. You should buy that house. You want to live in a home. You need somewhere to live anyway. You're going to pay rent. And if it wasn't for high rates, there wouldn't be a refi market. So you wouldn't, if you didn't have this market today, you wouldn't have all the refis you did 8 months ago. So you need these rates to have that business. And I would say definitely be excited for a good upcoming year. Be positive. And I think everyone will do really well. Especially you got a coach. I don't think you could just look at the last year, how everyone was just giving you loans and it was just closing. You should be convinced that you're going to have to work hard to do well. Nothing should be easy. Then it wouldn't be worth it.
Exactly. But
marriage,
we
right?
have business. I mean, I think, what'd you say?
Like a marriage?
Yeah.
Yeah.
2023 is going to be great because those of us who are in it are really committed. And so it has taken an attitude shift. I mean, we've all gone through it to some extent, myself included for sure. But I'm looking forward to it. I think it's going to be very good. We're going to take these lessons, we're going to build on it, and we are going to have a lot of new ideas in the beginning of the year as far as what to do to build your business and continue to grow it. So Kevin and I take 1 week off a year. We do this 51 weeks a year, and next week is our Tuesday off. So we will not be seeing you again until 2023. We'll miss you desperately. I hope you enjoy every holiday that happens in between now and then. And we will see you January 3rd with Ginger Brell. And again, I just want to take a moment and say thank you so much to Gina Pasquini with Social RX, who has been helping us with the behind the scenes, getting our flyers out, helping us with social media and getting our acts together. And then Jason Bellevue, who has been he did our YouTube channel. He is the reason we have a website because he put us in touch with a guy. So we are functioning at this point because of this help we've had from people who just dove in and wanted us to keep this going. So thank you to everyone and to all of you for listening. We really, really love you. And we are excited for next year. And Michael, thank you so much for being here today. It was a pleasure.
Yeah.
And I look forward to seeing you again.
Same here. Thank you for having me.
All right.
you,
Have a
Michael.
great weekend, a great holiday.
Holidays.
Bye, guys.